What does the future hold for our economy in an era of unprecedented changes?
Join renowned analysts as they dive deep into pivotal market dynamics.
Our AI-powered summaries condense critical insights into quick, actionable takeaways.
Stay ahead of the curve to navigate this financial uncertainty with confidence.
Today, we're diving into an intriguing analysis by Scott Bent on the possibility of the Treasury engaging in quantitative easing, traditionally the role of the Federal Reserve.
Scott emphasizes the implications this could have on inflation and the perceived independence of the Federal Reserve.
Scott Bent proposes that the Treasury may have the necessary tools to perform quantitative easing itself.
According to Scott, this scenario raises significant questions about how it may affect inflation and the Federal Reserve's independence.
Scott Bent mentions that the Treasury claims to have a big toolkit for monetary intervention.
He critiques this assertion, suggesting that whenever they say they're prepared, historical evidence shows they often aren't.
What does Scott Bent highlight about the bond market's recent performance?
Scott indicates that the bond market's recent sell-off may not just be about a lack of demand, but rather a need for liquidity among investors.
What are Scott Bent's predictions regarding government-driven quantitative easing?
Scott warns that if the government engages in quantitative easing, inflation could rise, impacting consumer prices and savings.
What does Scott predict could happen if the Treasury initiates quantitative easing?
Scott believes that while the best case is a stabilization of the bond market, there is a real risk of increased volatility.
In conclusion, Scott Bent emphasizes the importance of staying informed about Treasury actions.
He suggests that investors should adopt a diversified strategy to hedge against possible inflation and market disruptions.
Today, we're examining Ray Dalio's insights on the US dollar and its future, as discussed with Stephan.
Dalio highlights critical issues such as rising debt levels and the changing global economic order that could impact investors.
Ray Dalio suggests that the US is approaching a long-term debt crisis characterized by a debt-to-GDP ratio of 122%.
He warns that historically, no reserve currency has maintained its status indefinitely, indicating a potential shift. Dalio explains that high debt levels could erode confidence in the U.S. economy.
So, could rising debt lead to a crisis if confidence shifts?
Precisely. When lenders lose faith in a nation's ability to repay, a crisis is likely.
What does Ray Dalio predict for the future of the dollar?
Dalio foresees a notable drop in the dollar's status as countries explore alternatives amidst rising tariffs and geopolitical strife.
Ultimately, both Dalio and Graham suggest being proactive in financial planning to navigate these uncertain times.
They both stress the importance of diversifying investments to mitigate risk against potential market changes.
Today, we're examining the tumultuous equity markets with insights from Chris Vermeulen, Chief Market Strategist at the Technical Traders.
Current market conditions represent a pause before a storm, indicating a deeper bearish trend ahead.
Chris interprets the recent calm in markets as merely a pause, suggesting it could precede significant volatility.
He believes we are in a bearish cycle where holding stocks is risky for investors.
What does Chris say about the current market conditions?
Chris points out that the market has entered a bearish cycle with emotional reactions driving panic selling among investors.
Can you elaborate on the bearish signal that Chris referenced?
Chris examines the S&P 500's charts, suggesting it's been in a bearish phase, indicating it might be time to exit positions.
What insights does Chris provide regarding market manipulation?
Chris emphasizes that institutional players often manipulate prices to create false buying opportunities that mislead average investors.
What are Chris's predictions for the market moving forward?
Chris predicts a potential drop of 25 to 55%, indicating that investors should prepare for further declines.
In conclusion, what does Chris recommend for investors during this market uncertainty?
Chris advises staying liquid, moving to cash, and being prepared to adapt strategies as the market evolves.
Today, we're analyzing the predictions on housing price declines, as discussed by the Reventure consulting team in their recent video.
The team asserts that substantial drops are forecasted in cities like Dallas, San Antonio, and across Florida.
According to the Reventure team's findings, home prices are expected to drop significantly due to a spike in available inventory.
They highlight three critical data points: inventory levels, price cut rates, and duration on the market. The Reventure consulting team emphasizes that an increase in these three factors suggests a buyer's market.
So they recommend watching these indicators closely.
The Reventure team specifically calls out Dallas, San Antonio, and Cape Coral for their declining housing prices.
They attribute this to high inventories and poor sales conditions in these markets. One stark prediction from the analysis is about Cape Coral, expecting steep declines based on current trends.
This mirrors the overall struggle of Florida's housing market as detailed by the Reventure consulting team. What does the Reventure team predict for home prices in the next year?
They caution that many cities, particularly in Texas and Florida, will see home values drop sharply, some by nearly 10%.
In conclusion, the Reventure consulting team's analysis stresses careful monitoring of market indicators.
For potential buyers, understanding these dynamics can assist in making informed decisions in a fluctuating market.
Welcome back. Today we're analyzing the recent volatility in the gold market, guided by insights from Gary Wagner.
Gary highlights that gold reached its strongest weekly performance in 5 years, sparking questions about future trends.
Gary Wagner notes that the recent gold market movements are unlike anything he has seen before.
Wagner suggests that the explosive rise past 3,240 indicates a shift in market momentum, influenced by global uncertainties.
Gary explains the importance of using Heikin-Ashi charts, which reveal the strength of the current market trend.
He notes that the absence of lower wicks in recent candles indicates a strong continued upward movement in gold.
Wagner emphasizes the importance of consolidation following rapid price increases.
He believes that maintaining a range around 3,240 could signify a stable base for future growth.
When asked about future resistance levels, Gary identifies targets around 3,300 to 3,500 per ounce.
He conveys confidence that the market could continue to rise, barring significant technical setbacks.
Wagner is optimistic about gold rising to between 3,300 and 3,500 in the next few months.
He attributes this to the current market conditions and historical trends.
In conclusion, Gary advocates for a cautious yet proactive approach, suggesting traders buy on dips.
He stresses that holding positions while watching for consolidation can be beneficial in this bullish market.
Today, we're diving into the current economic analysis presented on Eurodollar University, where the host discusses the challenges facing central banks globally.
The host's insights reveal a challenging economic situation as central banks are being pressured to lower rates.
The host emphasizes that central bankers are under pressure to cut rates despite previous commitments.
They specifically mention the Bank of England as facing stark employment data amid a slowing economy.
The host highlights concerning trends in the UK labor market, citing the drop in payrolls as a critical indicator.
With many businesses facing challenges, the outlook for employment in the UK appears increasingly bleak.
The analysis points out alarming changes in German investor sentiment, which dropped significantly recently.
These shifts may foreshadow serious economic repercussions in the Eurozone.
The host warns viewers about the rising threat of deflation, challenging the traditional inflation narrative.
This deflationary risk could significantly influence consumer behavior and market stability.
The host discusses predictions for interest rate cuts, highlighting consensus around declining rates.
Expectations now suggest a prolonged period of historically low rates as economic conditions worsen.
In conclusion, staying aware of central bank decisions can assist in navigating the economic landscape ahead.
Preparing financial strategies and looking at alternative investments could offer some protection against ongoing economic uncertainty.
Wow, what a lineup of powerful insights we've had today.
Absolutely. The variety of perspectives from our guests really painted the broader economic picture.
One standout point was the consensus on economic instability. Everyone seemed to agree we're in tricky waters.
Right? And it's intriguing how the Eurodollar University highlighted central bank challenges, while Chris Vermeulen sounded the alarm on the equity markets.
And then you have Gary Wagner predicting gold prices could skyrocket, which really stirred the pot.
Indeed, his bullish outlook contrasts sharply with the more cautious tones regarding the broader economic fundamentals.
If today's discussion helped you understand these complexities, make sure to like and subscribe.
Your support fuels our mission to continually bring you expert insights.
Don't miss our next episode. We'll dive into the nuances of global monetary policy.
See you next time.